Imagine a factory that never sleeps. While the lights go out on the trading floors of New York and London, and the settlement clerks go home for the night, somewhere in the code, a different kind of market continues to move. Trades execute, liquidity is provided, collateral shifts hands, all without a single human hand on the lever. This is the ghost in the machine. Not a metaphor for artificial intelligence alone, but the quiet emergence of autonomous, always-on liquidity that settles in seconds rather than days. Wall Street still runs on cycles measured in business days. The chain runs on mathematics. Tonight we examine why on-chain liquidity is no longer merely an alternative. It is beginning to set a new standard for speed, transparency, and capital efficiency in specific high-stakes domains. And we will do so without the usual exaggerations. The numbers do not yet show on-chain volume eclipsing the great equity exchanges. What they do show is a structural advantage that is forcing the old system to adapt or risk being left behind in the places that matter most. You are watching the Signal and Noise podcast. Make sure to like and subscribe as we analyze with no emotions or bias, just raw data analysis, pointing towards the signal and dispelling the noise. This is not financial advice. Do your own research. Let's get into it. For decades, the backbone of global markets has been the settlement cycle. Trade today, settle tomorrow, or the day after. T+1 became the new American standard, a hard-won improvement over T+2. Yet even that improvement still leaves capital trapped, counterparty risk open, and operational friction high. A market maker on Wall Street is limited by the physical and legal latency of centralized banking rails. Funds must clear. Messages must pass between custodians, clearing houses, and banks. When volatility spikes, circuit breakers halt trading to protect the system, and in doing so, they freeze liquidity precisely when it is needed most. Meanwhile, modern blockchain architectures offer near-instant or sub-second finality. Once a transaction is confirmed and reaches finality, the asset has moved. No multi-day window, no overnight funding cost for that particular transfer. Atomic settlement becomes possible. The asset and the payment change hands together, or not at all. Institutions know this. That is why DTCC, the great plumbing of American securities, has begun live production pilots of tokenized treasuries and equities. That is why experiments in real-time settlement continue. Yet the legacy stack still clings to manual oversight, permission silos, and the comfort of the known cycle. The paradox is clear. Wall Street wants the benefits of tokenization while remaining reluctant to fully surrender the control structures that make those benefits possible. The friction is growing. Every day, the gap between what code can deliver and what the old rails still require becomes harder to ignore. Enter the automated market maker. What began as simple constant product pools has evolved into sophisticated, range-bound, and increasingly intelligent liquidity engines. Concentrated liquidity allows capital to be placed only where it is most useful, dramatically improving efficiency compared with the old full-curve designs. In theory, far less capital is required to achieve the same depth around the current price. In practice, the picture is more nuanced. Recent data shows a large percentage of concentrated positions still sit outside their active ranges at any given moment, capital that is deposited but not earning. Traditional institutional order books, by contrast, rely on human and algorithmic market makers who can pull liquidity when risk becomes unacceptable. On-chain liquidity, once committed through incentives, tends to remain more permanently available. It does not flee at the sound of a circuit breaker because there is no central switch to throw. Code-based incentives, emissions, fee-sharing, point systems attract capital that is structurally different from the fleeting depth of a traditional book. This capital can be more patient. It can also be more fragile when the incentives change or when smart contract risk materializes. The comparison is not that on-chain has already defeated the order book. It is that mathematical liquidity offers a different trade-off. Greater transparency, continuous availability, and, in well-designed pools, superior capital efficiency for certain asset classes and sizes, for long-tail assets, and for continuous 24/7 markets. The advantage is already decisive. Look at the actual flows of 2026. On-chain spot volumes across major decentralized exchanges run into the hundreds of billions of dollars monthly when EVM chains and Solana are combined. Perpetual futures venues, such as hyperliquid process, substantial institutional-sized flow. Tokenized equity volumes on decentralized exchanges have set successive records. though they remain a tiny fraction of traditional equity turnover. The claim that on-chain volume consistently eclipses major stock exchange daily turnovers does not hold. The great equity markets still move orders of magnitude more capital. What the data does show is rapid growth in specific niches, tokenized assets, on-chain derivatives, and machine-to-machine payments, and a qualitative difference in how that liquidity behaves. The ghost is the autonomous smart contract. It does not sleep. It does not require a middleman's fee for every match. It executes according to predetermined rules. During periods of extreme volatility when centralized venues have paused trading, certain decentralized pools have continued to function, providing continuous price discovery and exit routes. That resilience is real. It is also incomplete. Oracle failures, governance attacks, and liquidity fragmentation remain risks that no amount of code fully eliminates. The proof is not that the old system is dead. The proof is that a parallel system now exists that never closes, settles faster, and is open to inspection by anyone who can read a block explorer. The migration is underway, but it is cautious and hybrid. Top-tier funds are not wholesale ditching prime brokerages. They are experimenting, deploying into permissioned liquidity layers, curated vaults, and regulated on-chain venues that combine the speed of the chain with the compliance controls institutions require. Uniswap's permissioned pools, Morpho's curated vaults, and institutional activity on high-performance perpetual venues illustrate the pattern. Talent is moving. Quantitative traders are drawn to environments where execution is transparent. Latency is measured in milliseconds of block time rather than hours of clearing. Real-world assets have moved from narrative to functioning collateral. Tokenized treasuries, credit, and other instruments now sit in DeFi protocols as productive capital. Their total value remains modest relative to the vast traditional collateral markets, measured in tens of billions rather than trillions. Yet the trajectory is clear. Once an asset is tokenized and accepted as collateral, it can move at the speed of the chain. The drain is real in specific desks and specific strategies. The full institutional stack, however, still relies on the legal finality, netting, and recovery mechanisms of the legacy system. What we are watching is not replacement. It is the construction of a faster, more transparent layer that will eventually sit underneath, alongside, and in some cases in place of the old rails. Forecasts of the total obsolescence of the T-cycle within 24 months overstate the speed of change. Settlement cycles will compress. Atomic and near real-time settlement will become available for a growing set of assets. What is emerging is a unified, always-on liquidity layer. It will not be the only layer. It will be the one that never sleeps, that settles fastest, and that makes every movement visible. For the individual investor, the practical steps are measured. Understand the difference between public permissionless pools and permissioned institutional venues. Recognize that capital efficiency gains come with smart contract and Oracle risk. Watch the growth of tokenized collateral and on-chain derivatives as leading indicators, and maintain exposure to the infrastructure, both the chains and the protocols, that are becoming the settlement and liquidity fabric of the next market structure. The ghost is already here. It does not announce itself with fanfare. It simply continues trading while the old floors go dark. On-chain liquidity has not yet outpaced Wall Street in raw volume. It has outpaced it in finality, in continuous availability, in transparency, and in the capital efficiency. Those advantages are structural. They are forcing tokenization, faster settlement experiments, and a gradual migration of talent and strategies. The future is hybrid. The chain will not swallow the legacy stack whole in the next 2 years, but finance will increasingly live on the chain. The ghost in the machine is not coming. It is already matching orders while we sleep. If this documentary view of the liquidity shift resonated, make sure to subscribe, like, and drop a comment. What do you want us to discuss next? Why central banks are testing atomic settlement to replace the correspondent system, or the real reason global insurance giants are quietly tokenizing trillions in liabilities? The next chapters of this transition will be written in the blocks themselves. This is Signal and Noise. The markets never close anymore. Stay sharp, stay updated.